We continue with our discussion on Unit 2 of Financial Reporting and Analysis, and we are now going to get a little bit deeper in terms of the accounting process. We're going to understand the nomenclature around journals, ledgers, and the trial balance as we go along, right? Before we go there, we will also try and understand what kind of accounting systems exist, right? So let's begin with the broad kind of accounting systems that exist, and there are three of those. You could have cash-based accounting, you could have mercantile basis accounting, and you could have mixed or hybrid basis accounting, right? Let's understand each one of these separately. Let's begin with the cash-based accounting. Now, under the cash basis, transactions are only accounted on the receipt of cash, receipt or payment of cash, right? So unless you have made a receipt of cash, you have received cash, or you have made a payment of cash, you will not account for the transaction, right? The system of accounting usually does not consider income to be received or expenses to be paid. So whatever is in or out in terms of cash is what is accounted for. Whatever is supposed to come in is not or supposed to be paid is not accounted here. So by logic, this system will not allow the concept of a receivable or a payable. That is not allowed here in a cash basis system. Sale of goods is accounted only when cash is received and not when sales takes place. So that's the cash basis. Under the mercantile basis, the transactions are recorded as and when they are due. For example, in case an interest income of 1500 is due on 31st December, then that is recorded as income on that date. However, it will not be shown as received. The entry for receipt will be made on the actual receipt of the amount, right? So usually you find this that on the day it is due, it is recorded as an income on that day. And when the receipt is made, you will receive it on that day. Correct? That's what happens in the mercantile basis accounting systems. And under the hybrid basis, a mixture of the above two systems is incorporated, resulting in a hybrid system. Under this system, all cash transactions and certain selective transactions like credit purchases and credit sales are recorded, right? So that's a mix of the cash basis and mercantile basis. Typically, this is the most commonly seen system as we go along, right? Let's revisit our discussion on the entire recording process of the accounts, right? So we get what is known as vouchers, and vouchers are basically every time you do a cash transactions or something, you will find a quick voucher that comes where you say that you've paid so much amount to someone at a certain price point. You create something called as journals out of that. This is called as bookkeeping, also known as journalizing the entire transaction. From journals, you create what is called as a general ledger. And from general ledger, you will move towards a trial balance. The trial balance, these two processes are part of what is called as the creating the ledger, and creating the trial balance are part of what is called as the accounting. And from the trial balance, then you can basically report the balance sheet, P&L, and cash flow statements. Now we are going to look at these three items separately. What is a journal, what is a ledger, and what is a trial balance? That's going to form the crux of our discussion from now. And that is what we're going to look at as we kind of proceed. So let's understand a journal. Now, in the context of journal, a journal is a book of original or prime entry containing chronological record of transactions from which posting is done to the ledger. So there are two points here. The first is original or prime entry, right, which is the first entry happens here. Second, it considers a chronological record, which is basically nothing but date-wise transaction posting happens in a journal, right? Transactions are recorded first in the journal in the order in which they take place or they occur. The process of recording a transaction in a journal is called as journalizing, right? That's what we are doing when we are recording this transaction, right? A simple example is posted here, which is a certain account, remember, gets debited and a certain account gets effectively credited. So what is the debit amount that comes here? What is the credit amount that comes here, right? And also it is here that we can recall what is a real account and what is a nominal account and what is a personal account, and what gets debited and what gets credited, right? Let's assume someone starts a business putting in 1 lakh cash as capital, right? So which account gets debited? Remember a couple of things. One, effectively an asset going up, an asset account gets debited when something comes in. So technically your cash account should get debited. Also, cash is a real account, correct? We read about real, nominal and personal, and real account, in a real account, debit what comes in, right? We remember this just to kind of ensure that we remember this. We can take a look at this, and we say what comes in gets debited. So cash comes in, and remember, capital account is basically a personal account. Someone is giving that capital, right? So who's the giver? The person who's giving that capital, we have to credit that, right? So effectively the capital account will get created here, and that is what is credited, and the cash account is what gets debited, right? Let's record it there. So your journal would basically create something like this: capital account, and whoever's capital it is. If it is person XYZ, then XYZ capital account. That's where credit happens. You put 1 lakh here and you put 1 lakh here, right? This is a personal account and this is a real account. Real account, debit what comes in, personal account, credit the giver. These are the rules, remember. Once we have identified what kind of account it is, then it becomes much simpler. Also, remember, we said assets going up is a debit. Just remember this. Once you remember assets going up is a debit, then everything else is a credit on the other side straight away, right? That's a simple way to record a journal entry. That's a very simple journal entry where capital account gets credited and cash account gets debited. There are more pointers to remember in this journal. First part of the journal entry is a date on which the transaction happens. So chronologically, you will put the data, particulars, and you can put the narration here: being money provided on account of starting the business, right? We can put the narration here. There is a ledger folio number that is available here. It's basically in the ledger page book. Where do you find this entry happening? What is the debit amount? What is the credit amount? That's how basically a journal will appear, right? You could also have compound journal entries, right? When one or more accounts are debited or credited in the same transaction, right? For example, while starting the business, the capital may be put in the form of cash, bank balance, and buildings, correct? Note that all these are kind of real accounts, right? And capital account is a personal account. So you credit that, being the business commenced with the capital of rupees. So whatever, maybe you had put in a capital of 2 lakh rupees, from which out of 2 lakh rupees, you put in fixed assets worth 1 lakh, you put in 80,000 in the bank, and there's another 20,000 lying idle as cash with the company, right? That's basically how you would create a journal entry. That's how you go about working with the journalizing of the transactions. There's a minor error here. The bank account will also be a kind of a personal account, but we are debiting the receiver here, right? This, remember, is the receiver. So debit the receiver, credit the giver is what the personal account was. That's what we have basically put in here, right? That's what we mean by compounded journal entries, and that's what comes in journal. Each entry that a business does gets recorded this way, and as you keep recording these entries, the overall journal gets created. There are a lot of entries that go into the journal, right? From this, you can then construct what is called as the ledger. So now what is the ledger? The ledger, the entire group of accounts maintained by a company, is the ledger. The ledger keeps in one place all the information about changes in specific account balances. Now, what do we mean by accounts? This is all the real, personal, and nominal accounts that we had studied about. All these accounts, the details of these accounts where things get classified, cash account, salary account, bank account, capital account, investment account, furniture account, all these accounts will be put in one place. A ledger is a book of main entry and it contains various accounts such as personal, real, and nominal accounts. It's the principal book of accounts where identical transactions related to specific persons or things are entered. So if you buy two furnitures, they will come in the same real account, right? Similarly, if a same person basically gives you credit twice, that will come in the same personal account. So identical transactions related to specific, entities or things are essentially captured in the same account, and each of those accounts combined together form what is called as the general ledger, right? A ledger, companies may use various kinds of ledgers, but almost every company will have a general ledger. A general ledger consists of all the asset, liability, and owner equity accounts, right? So individual asset accounts, individual liability accounts, owner equity accounts like equipment, land, supplies, cash, interest payable, salaries payable, accounts payable, notes payable, expenses, revenues, owner's drawing, owner's capital. So everything basically gets combined in this ledger. All these individual account headers are captured in the ledger of a firm. So next we kind of move ahead to understand how does this account get created. So a simple T account is very useful for illustration, but in practice, the account forms used in ledgers are much more structured. So for example, if you look at a cash account, what has come in and what has gone out is basically going to continue, and you keep getting the balance after each transaction, and on each date chronologically you'll keep putting in the data points, right? So cash account will appear something like this if you look at the standard form of a cash account. So ledgers are much more structured, and cash being a real account, debit what comes in, credit what goes out, so inflow and outflow, and you can record it and the remaining balance keeps staying there, right? That's how you would see a ledger. So now transferring journal entries to the ledger accounts is called as ledger posting. This phase, basically what it does is, of the recording process, it accumulates the effects of journalized transactions into the individual accounts, right? Now the process involves the following steps. First, in the ledger, the appropriate column of accounts is debited. In the appropriate those columns, enter the date, journal page, and debit amount as shown as in the journal. Let's assume all these are books, so you will show what is the column that is being debited, what is the amount, date, and number of page of the journal. Let's assume journal is a book. In the same book of journal entries, in the reference column, write the account number to which this entry is posted. Now, account number could be cash account is 101, bank account is 102, and so on and so forth. You could have those account numbers. The same thing is done on the credit side, where appropriate column of accounts is credited, and the date, journal page, and credit amount is shown in the journal. And in the reference column in the journal, we write the account number to which the credit account was posted. Let's see an example that will clear things out. So this is the journal where we had put in cash and owner's capital. 15,000 of owner's investment in the business is done in, correct? Now on 1st September, step 1. So that's step 1. You put it in journal ledger and put in the transaction of debit, right? So entry J1, J1 comes from here. You put a debit of 15,000 here, correct? And the balance becomes 15,000. Now, in the account, which is the cash account where you are putting this in, general ledger will have accounts for each would have these tables for each of the accounts. Cash account number is this, which is 101. So the second step 2, is putting 101 here as reference. So these two get linked and you know clearly what entry is going where. So you're saying that cash account is basically account number 101 and we have put it there, right? And reference of journal is J1. Step 3, this 15,000 goes and puts in another account called owner's capital, where you credit 15,000, J1 being the reference. Same journal, remember. The same journal entry will have two entries in the ledger at this point. So the balance is 15,000 here, and then the 306, which is step 4, goes and sits here. So you know that owner's capital is account number 306 and cash is account number 101. And based on these are usually system generated accounts, you don't need to put those numbers in. And that basically defines how do you create a ledger. So the general ledger will have all these entries going from journal into respective accounts. Whatever accounts are there, in those accounts, you'll keep adding whether there is a debit or a credit entry, and then you keep finding the balances out of it, right? So that's the process of ledger posting. And how do we create a ledger out of it? Which then, once we have created a ledger, the next portion comes, which is called as a trial balance. Now, a trial balance may be defined as a statement that contains balances of all ledger accounts on a particular date. So ledgers will keep adding the data entry points, just like here, date wise. At the end of this, maybe at the end of this month, we are going to kind of account the balances of all ledger accounts, right? Now it consists of a debit column with all the debit balances of accounts and a credit column with all the credit balances of accounts. So you'll add all that, all the balances and put it there in the trial balance. The trial balance proves the mathematical equality of debits and credits after posting. Now, what this basically means is that after every transaction on any given date, the balance sheet needs to remain balanced. If the balance sheet starts in position A, then whatever you do after this is going to have an equal amount of debits and credits. The mathematical equality cannot go wrong anywhere, right? Now, automatically it'll uncover errors in journalizing and posting. In case it is not equal, something has been missed out somewhere. In addition, then it is useful in preparation of financial statements because you will combine all the entries. So for example, if we look at this cash account, this is going to give us what is basically a debit balance. So at the end of it, you could create a balance here and write 9450. So when you create the trial balance, you will say cash account, and on the debit, you will put in 9450. So similarly, other accounts will have some credit here or there, and that should match at the end of creating a final trial balance, right? So that's basically how you go about looking at a trial balance. What is the purpose or what is the objective of creating a trial balance? To provide a check on the arithmetical accuracy of books of accounts, because if there is a double entry system problem, you will find there's a problem there. It'll help you in locating errors. So both of these are kind of similar. Provide a basis for preparation of final accounts. It becomes easier for you to locate the accounts and then, basically kind of create final accounts out of that. Summary of ledger accounts. Ledgers are summarized and you put them there. So you can click on that and then you'll go back, and typically an accounting system like Tally will give you that feature where you can work that. Helps in comparisons, helps in making any adjustments. Once you can compare year on year or for multiple businesses what kind of activities are happening, and you can make adjustments at the end. Once you find that one particular month something went up, something went down, you can probably help your business adjust that, right? What are the limitations? It does not guarantee freedom from recording errors, right? There could be errors that exist even if the columns agree. Columns agree because debits and credits agree, right? But if you miss a transaction altogether from the journal, then there is a problem. 15,000 rupees coming in, an entry was completely ignored altogether. That might still balance, but you'll probably have missed the transaction, right? Correct entry is not posted. Instead of 15,000, you wrote 12,000, right? So as long as both the sides have 12,000, it will get balanced again. A journal entry is posted twice. You put the same entry twice, thrice, multiple times. Incorrect accounts are used. Instead of cash, you use bank, for example, right? For journalizing or posting. So at the end, you could, while the ending balances are the same, you could have a problem where the trial balance may not look correct, right? Offsetting errors are made in recording the amount of transaction. So I make two errors, one of plus 5,000, another of minus 5,000. It'll be difficult to catch this directly, right? So as long as equal debits and credits are posted, even to the wrong accounts or the wrong amounts, then the total debits will equal the total credits. And so the trial balance does not prove that the company has recorded all transactions or that the ledger is correct. All it says is that in its wisdom, if there is an arithmetic problem or there is a mathematical problem in terms of linking two numbers, that is what can get captured by a trial balance, right? That's basically what a trial balance would look like. So that's the limitation of a trial balance. A sample trial balance on a given date, right? So on any date will look something like this. All your debits, all your credits will come. And now you can go back and put all your thumb rules once again in place. Assets increase is debit. Asset decrease is credit. Liability increase is credit. Liability decrease is debit. Revenues are credit. Expenses are debit. Remember, we did all this. Sorry. Look at all the accounts that you see. Assets, 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 assets. All of them are debit. Then accumulated depreciation is a decrease in asset, that's credit. Accounts payable is liability, 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 and liability. All of these are credits, right? Dividend is effectively a drawing of the owner's equity. So owner's drawing basically, that will be a debit. Revenues are credit. All expenses are debit. Typically, a trial balance would appear like this, where both the debits and credits should match. If they are not matching, there is a problem. There is a problem that has been committed in all the transactions. The moment transactions are given and you're asked to create a trial balance, all you need to follow is this set of thumb rules. If you follow this set of thumb rules, automatically all the numbers will fall in one place or the other, credit or debit, and they should match. If they're not matching, something has been missed somewhere. Some of these things may not be very clear at this point of time. So as you keep doing a few more exercises, and we will do a few more exercises in forthcoming videos, it will make things much simpler and clearer for us to understand and put them in perspective. But that's basically it in terms of the entire accounting process. Remember, in most likelihood, we may not be asked to prepare these because that's possibly jobs of accountants, but we do need to interpret and understand if something is going wrong somewhere. And there are basically just two sets of thumb rules that are used. One is this, and the other is the kind of accounts that you saw. Based on those accounts, what is it that a personal, real, or a nominal account gets debited or credited, right? That's all that you need to remember. And just like always, when we close, we are asking two questions here. Just try and answer these two. Mention any two benefits and limitations of trial balances. And a company starts business with shareholder capital using rupees 4 lakhs of share capital in buying rupees 2.5 lakh worth of machinery and keeping the remaining 1.5 lakh in a bank account. Create a journal entry for the same. Thank you.